While the market is pricing in a September rate cut, our next guest says economic signals could easily make the case for a hike instead. Joining us now is Grant's Interest Rate Observer, founder and editor, Jim Grant. Jim, it's great to have you back on the show. Welcome.
Thank you, Morgan. Nice to be here.
So let's start right there. Why do you think that the case could be made for a hike rather than a cut?
Well, a part of it is the old William McChesney Martin punch bowl analogy. You want to take away the punch bowl and the party just get started. But the financial party has been roaring, and you see all manner of symptoms in data and indices from valuation to the return of the SPAC king and the little tiny rug pull stocks creeping out from under the carpet. And, so I think that, and you know, the economy seems to be doing okay, and inflation is still problematical. So I'm not sure there's a compelling case for a cut. In fact, I doubt that. And, you know, the financial conditions index of the Chicago Federal Reserve Bank itself reads one of the easiest readings in many years. So I think it's not a foregone conclusion. The market is treating it as such. And I think part of that has to do with the political narrative created and marketed so fervently by the White House.
I think there's a lot of anticipation and expectation baked into this market right now, arguably, or at least among investors, that you could have a Powell that shifts a little more dovish when he speaks at Jackson Hole later this week. Sounds like you don't think that's the case.
Well, I certainly don't know what the chairman's going to say. I think he would be superhuman if he were not affected to a degree by the voices surrounding him. Like cannon fire that he must cut. You know, it's quite an extraordinary thing. Not unprecedented, by the way. I mean, President Andrew Jackson was just as abusive towards Nicholas Biddle in the day as, subtly abusive than Donald Trump is towards Jay Powell. But in the 21st century, this is something unusual. So I think that the chairman feels that. He resists it with great dignity. But I think that there's kind of a preference cascade for lower rates worldwide. And I don't think it's necessarily advisable, but it is a thing. So I think the case can be made for higher rates, but almost certainly there will be some concession to the lower rate zeitgeist, so maybe 0.25% in September.